South Africa Financial and Market Developments, the 25th of July 2026. South Africa's fiscal outlook remained in focus after the National Treasury secured a 1.5 US billion dollar, approximately 27.3 billion rands development policy loan from the World Bank. The funding will be used to support key infrastructure projects, including electricity grid expansion and improvements to freight rail corridors as part of broader structural reform efforts. While Treasury described the facility as a cost-effective source of financing, some analysts noted that continued reliance on multilateral funding reflects the ongoing pressure on the country's public finances. Government bond markets also remained under pressure, with yields on long-dated bonds such as the 2040 and 2048 staying elevated. Investors continue to demand higher returns following June's 5.0% inflation reading. The South African Reserve Bank's decision to leave interest rates unchanged and concerns over rising global oil prices. Market participants are also awaiting greater clarity on the country's fiscal outlook ahead of the medium-term budget policy statement. In the energy sector, Eskom confirmed that a significant share of funding for its 343 billion rand 5-year capital investment program will be raised through its refreshed domestic medium-term note framework. Institutional investors will be watching closely to see whether the utility can successfully raise the required capital without relying on additional government guarantees. Economic commentators also renewed calls for faster reforms in South Africa's energy and logistics sectors. Business groups argue that accelerating electricity market deregulation and improving freight transport would strengthen economic growth. At the same time, private sector investment in electricity wheeling projects continues to expand, helping ease some of the pressure created by constraints in state-owned infrastructure. On the JSE, mining shares remained among the market's stronger performers as gold prices held above 4,000 US dollars per ounce, providing support for major producers such as AngloGold Ashanti and Gold Fields despite broader market weakness. Retail and consumer-focused shares, including Truworths and Mr Price, came under pressure as investors remained cautious about consumer spending. With the prime lending rate still at 10.50% and transport costs remaining elevated, analysts believe many households are continuing to limit discretionary spending. The telecommunications sector proved more resilient, with companies such as Blue Label Telecoms and other major operators holding steady. Continued demand for digital payment services, virtual transactions, and enterprise connectivity helped support sentiment across the sector despite broader market uncertainty.